let's talk our big picture discussion. We have Ann Sonders and Kathy Jones with about 8 minutes left in the session here. Ann's the Chief Investment Strategist at Charles Schwab, and Kathy Jones, the Chief Fixed Income Strategist. Great to have you ladies this afternoon for Fed Minutes Day. Kind of our one possibility for some action, but I think we kind of knew, Ann, that this was going to be pretty muted in terms of surprises.
Yeah, I don't think anybody expected that there wasn't a discussion about pausing, and there seemed to be unanimity on that. They did say again, as Powell expressed in the press conference after the most recent FOMC meeting, that they're looking at the sort of structure of the Fed and how they make decisions. They did cite sort of an even balance in terms of the risks on both sides of their mandate, employment and inflation, but also suggested that there was upside risk to inflation, particularly given policy uncertainty. So nothing terribly market moving, but I think important points.
Kathy, were there any interesting nuggets in there by your standards?
Really not very much. They did indicate for the first time that they're looking at ending QT, quantitative tightening, probably, we estimate around mid-year. And this really has to do with making sure that there are enough reserves in the system, especially if we get into a debt ceiling problem. So, but this has been long anticipated among Fed watchers. Lori Logan, the president of the Dallas Fed, will be speaking next week, and I think that will be a closely watched speech for kind of laying out the plan. But again, not too shocking. It's just the first indication we've seen that, yes, this is the plan to end QT.
Okay, that's a pretty good nugget, actually, that I think we kind of lost sight of a little bit, thinking so much about rates. But as the market kind of settles into the rate expectations with some agreement, gives us a chance to concentrate on other things like concentration. Ann, let's talk the market with stocks churning to highs, slow but steady. What'd you think of the last 24 hours?
Yeah, today's an interesting day. The market's okay. It's more flattish than anything else. But the year's best performer from a sector perspective, materials, riding the back of stronger commodity prices, and now at the bottom of the ranking today. And you've got more defensive areas like consumer staples and healthcare toward the top. I think it just illustrates some of these really wild sector leadership swings that we're seeing on a day-to-day basis, on a week-to-week basis. It's really hard to navigate around some of those really short-term shifts, which is why we continue to emphasize factor-based investing. And that's where there's been a bit more consistency in terms of leadership at the factor level. Momentum, which isn't really a fundamental factor, it just means what's working continues to work, at least in the short term. That continues to be in play, but lower volatility is kicking in now. High interest coverage, that's been a consistent factor of emphasis for us. So I think that's still the best way to navigate the market, is be mindful of not being monolithic in your decision making at the sector level or at the group level like a Magnificent Seven, but actually screen for certain characteristics to provide that boost in the portfolio.
Value had a pretty good day yesterday, and I know one of your favorite sectors, the banks, looks like it's close to a breakout as well, to 52-week highs. How much of that, real quick, Ann, is Fed related, do you think? Calm in bond markets the banks like?
It is, and the move back to a positively sloped yield curve. Financials also has one of the best earnings profiles, not just for the season we're reporting now, but looking ahead at least into the first half of 2025, and reasonable valuations.
Okay. Kathy, let's talk rates, and we talked gold at the top of the show, but to kind of come back to a point, which is the dollar connection. We were kind of figuring that out with David Newhouser at the top of the show, gold and real rates. And I'm curious from your perspective how you see the dollar relationship with rates and with the yield curve and what's happening in bonds.
The dollar's been pretty steady. It stays firm despite all of the kind of news flow that could cause some turmoil and volatility. It has stayed firm. We have seen the rise in gold. I think that despite high real rates, I think where the underlying driver there is that foreign central banks are increasing their reserves of gold. And maybe that's just a need to diversify in a very uncertain world here. But dollar continues to be driven by those interest rate differentials, remarkably come quiet and holding this firm level, I say, despite everything that's going on in the world.
Kathy, to follow up on that point, the dollar, as you mentioned, getting wrapped up in this tariff discussion. kind of like bonds, are kind of hard to figure out exactly what the news is going to be and what the reaction will be on top of that. But compared to the dollar's connection to rates, which one do you think is more driving the bus right now for the dollar? Do you think it's been that rate connection's been kind of usurped by tariffs, or will it still move with rates?
I think it'll still move with rates. And I think that there's still going to be divergence in rates among the major global central banks as we move into the future. But tariffs are there in the background as well, right? Tariffs continue to keep the dollar firm. But I think the rate differential is the real driver here. And as long as the Fed is on pause, maybe on pause for a very long time, but we're still seeing rate cuts elsewhere. You're looking at 2 to 2.5% interest rate differential. That means a lot compounded over time in terms of holding one currency versus another. So as long as the underlying dynamic is that the Fed's on hold because the U.S. economy is doing better than other economies around the world, we'll probably continue to see the dollar stay firm. That being said, you get enough turmoil here, you get a slowdown in the economy maybe later in the year, you could see foreign investment flow out, compounded by the tariff war situation. So by the end of the year, we may see a different dynamic. But right now, it's the rate differentials, I think, supporting the dollar.
Yeah, it kind of keeps it pinned. It seems like that. Lizanne, real quick, we talked yesterday about the number of companies trading above their 50 DMA. I know you're watching that too, but you've got another good breadth stat, which is the percent of S&P constituents that are beating the index itself. What's the latest?
Yeah, so if you do a trailing 1-year look back, it's only about 20% of the S&P's constituents that are outperforming the index itself. But if you look over just the past month, it's closer to 50%. So that's another way of measuring breadth, and you've just got greater participation. All else equal, I think that's a good thing, especially for active managers.
Fantastic. Knew it would be a great discussion. Did not disappoint. Thank you very much, guys.
Thanks.
Kathy Jones, Ann Sonders.